Welcome to Course 2, Unit 3, Lesson 5, Warren Buffett's fourth rule, determining the intrinsic value of a stock. In this lesson, we have two lesson objectives. The first is how do we calculate the intrinsic value of a stock, and the second is how do we use the buffettsbooks.com intrinsic value calculator. So let's get started. Okay, so here we are at the last rule for Warren Buffett, and this is the most complicated rule, and that's determining whether a stock is undervalued or not. Okay, so in the three previous lessons, we were looking at the three previous rules that Warren Buffett has, and we were comparing Sirius XM Radio and Disney to kind of understand those rules and those principles. And so when we looked at Sirius, the first rule that we were looking at was whether the company was managed by vigilant leaders, and so we were looking at the debt. And so for Sirius, they had a lot of debt, and it didn't meet that rule. And as you know from the previous lessons, all four rules must be met in order for Warren Buffett to invest in one of these companies. So since that rule wasn't met, immediately we'd be done looking at Sirius, and we wouldn't go any further as far as assessing its value. But we'll continue to go down through the rules so we can kind of do a comparison. Now, with respect to Disney on the first rule, we looked at their debt, and it was manageable through all the last 10 years, and the forecast looked like it was going to be more of the same. Now, with respect to the second rule for XM Radio, we kind of briefly talked about how we don't kind of anticipate that having long-term prospects in 20 or 30 years from now. Whereas for Disney, we do see long-term prospects. Then the third rule for XM Radio, the numbers were not stable. That book value was all over the place. The debt to equity was all over the place. And so with Disney, we saw a very stable company and something that was very predictable. That is absolutely essential as we move into this lesson where we're trying to calculate the intrinsic value. Without having a stable company, we can't make a very good estimate of how the earnings and how much growth the company is going to have in the next 10 years. So for XM Radio, I wouldn't even do the intrinsic value calculation for that because the company wasn't stable. But for Disney, we can do that. So let's go ahead and take a look at rule number 4, calculating the intrinsic value for the Walt Disney Company. And we know that the market price in the middle of May 2012 is $44.33. So we've identified that Disney's a great company, but is it worth the $44.33 per share? And that's what we're going to figure out in this lesson. Before we find the intrinsic value of Disney, I'm first going to start off teaching you how the intrinsic value calculator works. If you get lost during this portion, that's fine. I have a couple practical exercises for you to work on and for you to try out. So just kind of stay with me, and I think it'll all work out in the end. Okay, so how do we determine the intrinsic value of a company? So if you go to Berkshire Hathaway and you read his owner's manual that he has for Berkshire Hathaway, he gives some hints on how he determines the intrinsic value of a company. And so this is some direct quotes from Warren Buffett, and he says, the intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of a business during its remaining life. Okay, then he goes on to say, as our definition suggests, intrinsic value is an estimate rather than a precise figure. And it is additionally an estimate that must be changed if interest rates move or forecasts for future cash flows are revised. Two people looking at the same set of facts will almost inevitably come up with at least slightly different intrinsic value figures. So keep that in mind as we go through this. The tool in the calculator itself isn't different, but the way that you assess the cash flows in the future, you might take a more conservative approach than what I'm showing you, and that's fine. And when you do that, you're going to get a different intrinsic value using the same calculator. Let's say you want to use a different interest rate than the 10-year federal note. Well, then you're going to get a different intrinsic value. So as we start using the calculator, you're going to understand why Warren Buffett has this quote, because he might look at a company a little bit different than the way you view it, with a more conservative eye or a more liberal eye, depending on the way that you're looking at the future cash flows. So what does that mean? So when he says the cash that can be taken out of a business during its remaining life, what does he mean by that? Well, he's not actually, when he's assessing that cash that can be taken out of the business, what he's actually referring to is, if I could take all the profit that the company's going to make over X number of years that I would own it, how much would that add up to? And so what he does is he does it for 10 years into the future. And the reason that he does it 10 years into the future is because then he can compare that amount that he would collect from the business, or that profit for the next 10 years, to what he would make off of a zero risk investment which would be the 10-year federal note. And so that's why he only does 10 years into the future. So this quote might be a little bit misleading, but as we go a little bit further into this lesson, you're going to understand why we're only going 10 years in the future. So when you're looking at a business, if you remember back to the very first course with Unit 1, where we talked about the EPS, or the earnings per share, this is really the magic number. The EPS is the profit per share. So let's assume that we have $1.50 of EPS, which is your earnings for 1 year for a company, and we're just going to call it Company X. So that $1.50 comes into the earnings. Now, if you remember from that first course, the owner, which is you as the shareholder, has the option to either take the first route, which is you keep that money in the corporate bank account, and you're going to either invest that money back into the business or pay off your debts or whatever the case is. But what eventually happens with that money that you would be investing or paying off your debts, that either turns into more equity or less equity. And that's going to be reflected into the book value, because the book value is nothing more than equity per share. Okay? So if you take the option 1, let's say that $1.50 of earnings comes into the company, and you as an owner decide that, and you wouldn't be the person deciding that. Actually, the board of directors and the CEO running the company would be deciding this for you as your representative for managing the company. But they would decide if that $1.50 would turn into more equity or less equity, depending on how they choose to invest it or pay off their debts. Okay? Now, the second option that the board of directors and the CEO have in order to take that $1.50 of earnings is that they can just give you a dividend. They can just pay you, okay? So if a company decided to just pay all their earnings out in a dividend, that $1.50 would sit there in that bank account, and then the managers would decide to just pay it out to all the shareholders. So if you owned 1 share and you got $1.50 of earnings, it would come straight out into the dividends. And so what you actually see with companies is not that they take one option or the other, but they actually take both. So what you'll find a lot of companies do is they'll put a portion of that $1.50 into the equity, and then they'll put another portion of the $1.50 into the dividends. So they might pay 50 cents in the dividend and $1 into the equity of the business. But that total, that EPS is turning into either more equity or into dividends. And when I say equity, I actually mean book value, because we're talking on a per share basis. So I use those terms interchangeably, but remember, book value is nothing more than equity per share. So let's go ahead and look at this for this generic company, which we're going to call Company X. And then after we understand how this calculation works, then we'll go ahead and do it for Disney. Okay, so here we are, and you can see the model right over there on the left. And what we're going to do is we're going to look at this Company X over the last 10 years. And we're going to assume that the book value on the company, which is nothing more than the equity per share, back in 2002 was $10. Okay? And so our EPS is $1.50, and we're going to assume that that EPS was the same for 10 years straight, and it never changed. It was $1.50 every single year. So when we see that, we look at how the book value changed from 2002 to 2003. The book value increased by 70 cents. Okay? And then we look at the dividend, and they paid a 30-cent dividend. So if we look at how much money that EPS turned into, 70 cents was added to the book value, and 30 cents was paid to the dividend, and 50 cents just disappeared. Okay, and this is what you're going to see a lot of the times when you go back and look at a company is not all of that earnings per share actually materializes into money that's showing up in your pocket, because even though you're not actually seeing that book value payment, that equity that's being added to the business, the market price of your company generally follows a trend with that book value. So if that book value went up by 70 cents, you're going to see that your market price is generally going to trend in that same direction. So as we go from 2003 to 2004, you can see how the book value grew a little bit more than what it did from the previous year, and that the dividend remained the same. So the company got a little bit more efficient, and that $1.50 of EPS actually went more of it into your pocket. So as we go year by year and you keep going down, you can see that the book value continues to grow. And at 2012, the book value got clear up to $20, and they're still paying their 30-cent dividend, okay? And the EPS remained the same. And so if we sum all of the EPS that would have occurred for that 10-year period, we would have had $15. Okay? So if all the profit that that company received for one share would have ended up being $15. But when we look over at the combination of the book value and the dividend, which we know is the result of our two different options, it only ended up totaling $13. Okay? You can see the book value grew by 10, and then we just summed up all of our dividend payments, and that comes to $13 when we total those. So over a 10-year period, we essentially lost $2 just through the system that this company was operating. Okay, even though that profit was made through the cracks of the system, you lost $2 in actual money that should have gone into your pocket. So when Warren Buffett's talking about the cash that can be taken out of the business during its remaining life, when we'd be looking towards the next 10 years, we can generally assume that this company is going to continue to operate at this efficiency. So not all $15 of the EPS is going to be realized. You're probably only going to see about $13 if these numbers would continue to trend like this over the next 10 years. So that would be the cash that you're taking out of the business. That $13, that's what you're taking out of the business. And that's that magic number. So when we plot this, over on the right-hand side, you can see that I plotted the book value from 2002 to 2012. You can see that's a really nice linear-looking graph. And so what we're trying to do when we're trying to figure out the intrinsic value is we have to estimate how this book value is going to grow over the next 10 years. So if we could put a line right down on that graph and just plot that and look at the slope of it, we have a general idea that as we look to 10 years from now how that book value would continue to grow, just as long as those earnings remain constant and you're still making those earnings of $1.50 or more, we can generally say that this company here, Company X, the book value would probably be around $35 when you look at that slope and how it would be trending. We can also assume, and this is the assumptions that you have to make whenever you're trying to estimate how much cash can be taken out of this business for its remaining life, which we're doing for an additional 10 years, that let's just assume that that dividend is going to remain constant at 30 cents a year. That $13 was the cash that was gained over the past 10, but your job is to estimate how much cash will be taken out of the company over the next 10 years. So if the book value is growing linearly, use the slope to predict its future value. If the dividends are remaining constant or growing, use that slope to predict the future payments. And as you can see here, stability is everything. If you don't have something that's stable, how are you possibly going to be able to predict something like this? And the answer is you're not. But always remember, the book value growth and dividends come from the EPS. So when we're trying to figure out what it's going to do in the next 10 years, we have to always look at what the analysts are saying the EPS is going to look like next year and the year after that. And typically, those only go 2 years into the future. So always, always, always look at the projected earnings to ensure your estimated cash flows in the future are realistic. So you might have a great looking slope and everything might be linear, and then you go and look at the earnings that the analysts are projecting for next year, and they're really low and they're not even close to where they've been over the last 10 years. That's something you're going to want to run away from. You've got to make sure that those earnings in the future are looking very similar to what they've been in the past, because that's what's going to fuel your book value growth and also that dividend payment. So let's assume that we looked at Company X's future estimates, and in 2013 it's $1.50, in 2014 it's $1.55. So this would trend with the $1.50 that they've had in the past, and so we could go ahead and say, yeah, that book value is probably going to continue to grow at that same slope that we saw in the past 10 years, and they're probably going to continue to make this dividend payment. So that's how we can go in there and we can estimate what kind of cash we would get out of this business over the next 10 years. So here's another quote by Warren Buffett, and this is straight off of Berkshire Hathaway's owner's manual. He says, in other words, the percentage change in book value in any given year is likely to be reasonably close to the year's change in intrinsic value. And that's exactly what I just taught you. So use that with confidence and make sure that you're using something that's stable and not all over the place, because that's going to really throw off your estimates, and that's where you're assuming all your risk is in that lack of stability. So what was the average book value growth for Company X during the past 10 years? So let's go ahead and use the buffettsbooks.com calculator. And we're going to go ahead and use this chart right here. And we're going to do this for company X. And we're going to go ahead and estimate how much was that book value growing over the last 10 years. Okay, so right now I have the Buffett's Books calculator pulled up, which is just below this video. So if you scroll down, you can see that the calculator is broken down into two different sections. And what we're going to use first is the top section. And what this top section is doing is we're going to come up with a very rough estimate of how much that book value was growing annually throughout that 10-year period up to now where we're at. So what we're going to do is we're going to first input the current book value. And so when we look over there in 2012, the current book value for company X is $20. So you're just going to put $20 in there. And then and make sure you don't put in a dollar sign. You're just putting in the numbers. And when we look at the old book value, that's $10, okay, because that's where it started off. In 2002 was $10. And then the number of years between the book values is 10, okay? Now, if you look up there, there's 11 numbers, but there's only 10 years of growth between them, okay? So if you had 10 numbers up there, you would only use 9 years right here. So when we hit calculate, it shows you that the average book value change was 7.17% a year, okay? So that book value, when we went from 10 up to 20 over a 10-year period, that was growing at 7.17%. Now that number is really important because as we look into for the next 10 years, we know that the book value right now is 20. So that gives us a good idea of what we might want to use when we estimate how the book value is going to grow over the next 10 years for the bottom calculator. Okay? So now we can move down to this bottom calculator and we're going to use that number into this calculator. So the cash taken out of the business. So when we say the actual cash that's being removed from the business, we're talking about that dividend. Okay? Now, in this calculator, I have it set up so that the dividend, you only have to enter it for 1 year. And then what the calculator is going to do is it's going to sum that dividend payment as if you're getting it every single year for the next 10 years. So just put in the dividend payment for 1 year. So for 1 year, we're going to say that you would make a 30-cent dividend. Okay, so you put in 0.30 there. And then the current book value in 2002 is $20, so we're going to put 20 in there. The average percent change in book value per year. So this is what we calculated above. We got 7.17. So we're going to go ahead and put in 7.17 because that's what we expect the book value to continue to grow at. So this is where Warren Buffett says that, you know, any two people are going to come up with different figures because this number here, or if you would go back to the dividends and say, well, I think 30 cents is maybe a little bit of a high estimate or that's a low estimate. Maybe you might make a 35-cent dividend on average over the next 10 years. I like to take the most conservative approach as possible. So if it's a 30-cent dividend today, I'm going to use a 30-cent dividend for the next 10 years because that's a pretty conservative estimate in my opinion. Now, as far as the book value growth, if this number was really high, if it was over 15%, I probably would say that the calculator doesn't even work at that point because that's a growth company and not a company that's stable. But for here, I think 7% is a pretty average growth rate. So we're going to go ahead and use 7.7. So this is where the guesswork of the intrinsic value calculation really comes in. It's a matter of preference. It's a matter of risk. It's something that you're going to have to tailor to your specific needs. But for this, based off of how flat that line is, I'm going to go ahead and use the 7.17. So the years. So this is going to be the next 10 years. So if you're always comparing this to a 10-year federal note, this number here is always going to be 10. Now, the 10-year federal note. So this is something that you're going to have to look up because it changes all the time. For right now, it's 1.7 is the percent that you would get if you went out and bought a 10-year federal note. In the next section, when we calculate the intrinsic value for Disney, I'll actually pull up that number to show you where I would go to find that. But for right now, we'll just go ahead and use 1.7%. Now you'll notice I'm just putting in the numbers. I'm not putting in any percents or dollar signs or anything like that. For 1.7%, I didn't put in 0.017. I put in 1.7%. Okay. So all those numbers are in there, and then I hit calculate, and then it's going to give you the number in dollars. And so if this was an actual company, this calculator is saying that the intrinsic value of that company is $36.50. So that's all great, but you probably want to see this actually work with a real company. So we're going to go ahead and move on to Disney, and we're just going to go ahead and move our slide here. So let's do this for real with the Walt Disney Company. Like I said before, the market price for Disney is $44.33. So let's go ahead and figure out what that intrinsic value is for Disney. So here's the numbers for Disney. Just like we had for the company X, which was our scenario, we have these numbers up here for Disney. Now what I'm going to do is I'm going to show you how to find all these numbers off of MSN Money. So let's go ahead and do that right now. Okay, so here we are at MSN, their top level page, and we're just going to go ahead and scroll down, and we're going to go ahead and enter the Disney ticker, which is DIS, and hit enter. Okay, and it pulls up the Walt Disney Company. And so the first thing that we're going to look at is the trend for the earnings per share over the last 10 years. Okay, so we go ahead and hit this 10-year summary, and when you click on that, it brings up our chart, and we can see that the earnings per share over the last 10 years are right here. So we got $2.52 in 2011, $2.03, and it just keeps on going down. And you can see I have all those numbers input into this chart over here on the left. Now I left 2002 blank because we're using that year as a baseline value for the book value. So the next thing we're going to look at is the change in the book value. So how you would find that is you come back over here to MSN Money, and you're going to click on the key ratios. Now I want you to remember, if you're joining us just at this lesson right now, we've already done a lot of research on Disney, looking at its debt, looking at its current ratio and things like that to determine that this is a company that we can go ahead and assess. So some of those steps are already skipped, which you'll do for Warren Buffett's rule number 1 is rule number 2 and 3, and so on and so forth. So if you're joining us right now, you're kind of jumping in at the end. So I'd recommend going back and looking at those lessons before you come to this one. So when we get here to the 10-year summary, we clicked on 10-year summary, and we got the book value per share. Okay, and you can see the 1161 is this number at the top, the 1182 is the next number, and it keeps going down. And the current book value at the end of 2011 was $21.21. Now, if you wanted to go in and get an even more current book value than that, you could go into the balance sheet and you could pull up the equity, and you could divide it by the total number of shares outstanding to get an even more current book value than the one that's listed here. But for demonstration purposes, we're just going to go ahead and do it this way. Now, as for the dividend payment here, unfortunately, they don't have the 10-year history of the dividend on MSN Money and also a lot of other stock listing websites. So in order to do that, I went to the Disney website and pulled up their dividend history and what they paid, and that's how I pulled up these numbers. And so that's very likely for you, whatever company you're going to be researching, you're probably going to have to go to that company's website to pull up their dividend history in order to see those numbers. If you wanted to pull up the dividend that Disney is paying right now currently, the easiest way to do that, that's something that you can find on MSN Money. You'd go to the top level page, so we type in DIS and hit enter, and it brings you to this top level page. And you would scroll down and you'd look at the dividend rate. And you can see the dividend rate is right here, and that is 60 cents. Make sure that you're not using the dividend yield, because that's taking this rate and dividing it by the current market price. That's not what you want for the calculator. For the calculator, you want to use the dividend rate, and that's 60 cents if you're going to use that for the current dividend. And so that's what I'm using. Okay, so when we look at the EPS, if you remember, we had summed that up, and it came to $15.38 is how much earnings Disney made over the last 9 years. Okay, so from 2003 to 2011, their EPS totaled $15.38. Now, what that actually materialized into for the shareholder was $12.68. When we added up all those dividend payments and we summed how much the book value grew from 2002 to 2011, it was $9.60 and $3.08 for the dividends, and that totals $12.68. when we look at this chart over here for Disney, look how that book value was growing very steady. This is really predictable for a company. And this is what we're really looking for. We're looking for a company that we can calculate their value. You can't calculate the value on a company that has book value all over the place, dividends all over the place, debt all over the place. That just doesn't work. Okay, so for Disney, I think we can generally assess if we were going to drop a line on here and we were going to look at that slope, you could tell that Disney is probably going to be around the $35 range, $30 range in their book value by the year 2022. Okay, so here we are back at the Buffett's Books intrinsic value calculator. And just like before, we're going to go ahead and start at the top. And we're going to start off with the current book value. And what we're going to do is we're going to figure out how much Disney's book value has grown over the last 10 years. Okay, so the current book value on Disney, we're going to use $21.21. The old book value, which we're going to go clear back to 2002, and we're going to put in $11.61. Now, the number of years between those two book value terms, if you'd count them up, is 9 years, okay? Although there's 10 numbers up there, you're only going to use 9 years because the first is just a baseline. That's not counting a full year for it to grow. That's just where it started off, okay? So we're going to put 9 in there, and then we hit calculate. We realize that Disney's book value has been growing at 6.924% per year. That's the average per year, okay? So we're going to go ahead and use that average book value growth down here in the second calculator. So when we look at the cash taken out of the business, this is our dividend. This is our 1-year dividend. So currently, Disney's paying a 60-cent dividend. As you look over the last 10 years, that dividend payment has been a lot lower than 60 cents. They've just recently raised that up to 60 cents. So for me, most companies, whenever they set a dividend, they set that dividend at a fairly conservative value, because whenever a company lowers their dividend, it usually has an enormous impact on the stock price. So whenever Disney raised their dividend up to 60 cents, they did that probably as a pretty conservative move, knowing that if they even go into hard times, that they're going to be able to continue paying that 60-cent dividend. So for me personally, I'm comfortable using 60 cents in here for the calculator. You might want to use a lower value, or you might even want to say that, well, it's 60 cents now, but over 10 years, the average might be 70 cents or 80 cents. So this is where the guesswork comes in, and this is where people get different values for their intrinsic value. But for me, I'm going to use 60 cents. Okay, so I put in 0.60 there, and that's in dollars. Okay, and that's for the whole year. Those are the dividends you'll collect for the whole year, not for a quarter. Okay, so we got 60 cents in for the dividend. The current book value for Disney is $21.21. So we're going to put that in. And again, make sure you don't use any dollar signs or percents in here. Just put in the raw numbers. The average percent change in book value per year over the next 10 years. And so I'm going to use the 6.924%. Okay, and that's what we figured out on the top calculator. And that was based off of the previous 10 years. And so I'm going to use the same number for the next 10 years. If you think that's too high, well, then you use a little bit lower figure. That's up to you. And if you think that that's a little low, well, then use a higher number. Okay, so the years, we're going to go ahead and use 10 years because we're going to be comparing this to a 10-year federal note. Okay, although you use 9 years on the top calculator, that has nothing to do with the bottom calculator. Okay, that top one is just how many years were between your two book value figures. Down here, this is a completely different number that has nothing to do with your top number, so don't let that confuse you. You're almost always going to put 10 years in here, especially you're always going to put 10 years in here if you're comparing it to a 10-year federal note, which we are. Okay, so I promised that I would show you how I found the current value for the 10-year federal note. So I'm going to go ahead and do that now on the left-hand side of the screen, and I'll keep the intrinsic value calculator up on the right. Okay, so if you go to the U.S. Department of the Treasury, you can see that's where I'm at right now. And all you have to do is just type in 10-year federal note into Google, and it'll be the very first search result. And so you'll click on this chart, okay, and you'll come down here to the date. And so we're looking at the 18th of May, 2012, and you'll just come over on the chart until you see the 10-year mark, and you can see it's 1.71% for the 10-year federal note. When you go up to a 30-year bond, it's 2.8. But the one that we're going to be comparing, and the one that we're always going to be using for our intrinsic value calculation, is this rate right here. So if we were doing this calculation at the beginning of May, we would have been using 1.98. And so that goes back to Warren Buffett's quote whenever he said that, as the future cash flows change, or if interest rates move, the intrinsic value is going to change. And this is exactly what he means by that quote. So we would have had a completely different value for Disney back at the 1st of May than what we're going to have right now. So we're going to go ahead and put in 1.71, okay? And we're going to hit calculate. And it says that the value, the intrinsic value of Disney based off of those numbers is $40.43, okay? So if you are watching this video from YouTube, this intrinsic value calculator is found at www.buffettsbooks.com under the Course 2, Unit 3, Lesson 5 tab. If you want to go directly to the calculator, this is the web address that you would follow. It's http www.buffettsbooks.com and Intelligent Investor Stocks Intrinsic Value Calculator. So when we're looking at Disney, this is rule number 4. The market price that it's currently trading for on the market is $44.33. When we use the intrinsic value calculator, we found that the value of Disney is $40.46 when compared to the 10-year federal note. So what does that mean? What does that $40.46 mean? That means if you could buy Disney right now for $40.46, we estimate you get a 1.7% annual return on your money for the next 10 years. That's if you could buy it for $40.46. It's trading for even higher than that. It's trading for $44.33. So that means you're even going to get a worse return than the 1.7% over the next 10 years if you would buy it at that current market price. To answer the question here, is Disney undervalued? The answer is no, it's not undervalued. It's actually overvalued. So although Walt Disney Company had checked out on the first 3 rules, when we came to the 4th rule, was the company undervalued? That's a no, and so therefore we would not buy this company because it's overvalued. So let me show you something else that's pretty interesting. When we come back over here to the intrinsic value calculator, and we were using the 10-year federal note at 1.71%, and we're using that because that's considered a zero risk investment. So if I was given the choice between buying Disney for $40.46 or investing in a 10-year federal note, which one am I going to choose? Well, obviously I would pick the 10-year federal note because that one has zero risk, where the Disney company has more risk that it might not produce those returns that we estimated. They could be higher, they could be lower. So when you're faced with that option and the price is exactly the same as what you just calculated, well, the bond is obviously the better choice. So let's figure out what kind of return we would get for that $44.33 that it's currently trading for. So in order to do that, we're just going to come in here under this 10-year federal note tab where we put that number in, and let's go ahead and lower that. Let's put it in as 1%. We'll just put it in as 1.0 and see what value we come up with. Okay, so when we put it in as 1% return, the intrinsic value moved up to $43.18, which we're still not at the price that it's trading for. So let's go down to 0.8%. Okay, and there you go. We're getting pretty close to the value that it's trading at. So if you would buy Walt Disney at $44.33, you could expect to get 0.8% return on your money over the next 10 years. So that's not very good. And you can see that this company is trading for an enormous premium right now, way higher than I would ever buy it at. And so this gives you a real good idea of how you're doing that. So what I want you to do is I want you to come in here and I want you to play around with this calculator. I want you to get used to seeing how these numbers move. When you have a higher federal note value in there, you're going to see that that's going to drastically change that intrinsic value. And it's going to make it really easy for you to determine, hey, I need to be buying bonds, or hey, I need to be buying stocks because they're a really good value right now. This calculator is going to help you out so much, and I really hope that you get a lot of use out of it. And if you have any questions at all, I really encourage you to go ahead and click on the tab above on this website for the forum. If none of this made any sense or you have questions on how the calculator works, go and sign up for that forum and just start asking those questions, and I'll be more than happy to get in there and answer them for you and hopefully provide you some feedback that will help you start calculating the intrinsic value of these companies. So that's it. Those are his 4 rules. We covered all 4 of them. The last one here, a stock must be undervalued. We demonstrated that with the Disney company. And what I think was kind of unique is we went through the first 3 rules, and we had the Disney company checking out for all 3 of those rules. But when we finally made it to the 4th rule, which is the really important one, whether the stock is undervalued, unfortunately for Disney in this case, it was overvalued and it didn't check out on that 4th rule. So if we were exercising Warren Buffett's rules, we would not be buying any shares of the Walt Disney Company because it didn't pass that final rule. So this concludes Course 2, Unit 3, Lesson 5, Warren Buffett's 4th rule, determining the intrinsic value of a stock. We learned how do we calculate the intrinsic value of a stock, and then we also learned how to use the buffettsbooks.com intrinsic value calculator. I hope that this lesson really helped you out, and if you have any questions at all, make sure you sign up for the Buffett's Books forum and ask your questions there. See you guys in the next lesson.